Hello and welcome back to another video series dealing with chapter 12, which is partnerships, right? So on Tuesday we talked all about partnerships. We went through some examples of how to establish a partnership, how to get assets into the partnership. And in class we looked at what happens when we need to share income or share net loss and exactly how that works. Okay. So in this video, we're going to work on problem 12-1B, which is identical to your homework problem 12-1A. Okay. So what we got here is we have a post-closing trial balance for two proprietorships, right? On January 1st, 2017. And they give us all the numbers, right? These are the book numbers that they give us. And this is what I'm looking at right here. So we see that UTech company, based on the assets, the liabilities, the owner's equity, has about a value of $123,000, right? Same thing with Float company. Looks like their value is $93,000. Then they give us some additional information, right? They say that, hey, we need to value these non-cash assets. So they went ahead and they determined for us what the value of the non-cash assets were at the date that they established this partnership. That's these numbers right here. Okay. So remember, when we're looking at any non-cash assets, we need to value them. Excuse me. We need to determine what is their current market value or what is their fair market value. And that's the value that we need to use when we're booking journal entries for establishing a partnership. So let's just go ahead and bang out these journal entries. They're super simple, okay? So the first thing that we need to do, or what I already did actually, was just went ahead and created our journal for us, okay? So the first thing we need to recognize is that UTech needs to put all their assets, all their liabilities into this new partnership that they are forming with Float. Okay. We don't care about what the book value is on the non-cash assets. In order to determine their value, we need to use these new valuations that they gave us. Okay. So first thing I'm going to do is go ahead and list what am I putting in. Well, UTech is going to put in cash. They're going to put in accounts receivable. They're going to put in inventory. And they're going to put into this new business equipment. Okay. Then they're going to also put in their liabilities, right? We're transferring the liabilities from UTech proprietorship into this new partnership. So I need to indent and I need to list out my liabilities. Well, what do we have here? Well, it looks like UTech has notes payable of $20,000, accounts payable of $30,000. So I need to put those in there, right? Notes payable and accounts payable. And I also need to show what their capital account value is. So I'm going to say capital or owner's capital, it doesn't matter. But remember, we're dealing with a partnership. So that means we have two owners or more than two owners. In this example, it's just two, so we only need really two capital accounts, right? So this is UTech's capital account. We need to identify whose capital account it is, right? So I'm going to go ahead and just plug in my numbers, right? Cash. What's my cash valued at? Well, my cash is valued at 10 grand, right? It's not going to change. What about my accounts receivable? Well, they tell us that it's first of all, it's a non-cash asset. So we need to look at what is the current value of this accounts receivable. Well, they agreed that as as of January 1st, 2017, UTEC has an accounts receivable that has a fair value of $18,000. I'm going to plug that in. Okay. Same thing with inventory, right? The inventory is currently valued at 38,000. Okay. So that's the number I have to use, 38,000. Now, previously, UTEC had it on their books at $35,000, right? In the past, they bought inventory, they paid 35 grand for it, okay? They dissolved the proprietorship, or they closed the proprietorship, they took all the assets and they put them into this new partnership. That's what we're doing, okay? The fact that their inventory was valued at 35,000 doesn't mean anything to us. We want to know what is the value of that inventory the day that we establish this partnership. Well, we did some analysis. We found out that if today we were going to buy the same merchandise or the same inventory that we have, it would cost us $38,000 today. Okay, that's the amount we need to use. That fair value of $38,000, which I plugged in. Okay, same thing with equipment. What's the value of the equipment? Well, I could calculate book value, right? But book value means nothing to me at this point. I don't care that when UTEC was a proprietorship, they had their equipment on their books for what, 32,000, right? I took 60,000 minus accumulated depreciation gives me 32,000 if my math's right. Okay, I don't care about that. I want to know the day we start this partnership, what is the fair market value of that equipment? They tell us right down here it's 35,000. So I'm gonna plug that in. 35,000. Okay. Now I'm gonna list my notes. Well, notes payable. What's the current inventory, what's the current value? Well, they don't really need to revalue those. It's a notes payable. It says I signed a note saying that I owe somebody 20 grand. That's what we're doing. Okay. Same thing with accounts payable, right? What's their accounts payable valued at? Well, it's 30 grand, right? I owe somebody or a bunch of suppliers $30,000. I'm going to plug that in. Okay. Now, I missed one here. So I'm going to delete my UTEC capital. I need to credit my allowance for doubtful accounts. Okay. So let me go back over. Well, originally, UTEC guesstimated that their allowance for doubtful accounts is 2 grand. Well, upon further analysis, as of January 1st, 2017, they estimated that allowance for doubtful accounts really shouldn't be 2 grand. It should probably be 2,500 because we estimate that 2,500 of this receivable is not going to be collected. So we're going to book that fair market value or that updated estimate of $2,500. Okay. So now I need to figure out what is the value of the capital account for UTEC. Well, how do I do that? Well, it's easy. Think back to accounting 1. And what's the accounting equation? Assets have to equal the liabilities plus the owner's equity. We could reframe that and say, well, the owner or the accounting equation could also be owner's equity equals assets minus liabilities. Okay. So to figure that out, I'm going to auto sum all my debits. I'm going to add up all my debits here in this, just in this one journal entry. It's 101,000. I'm going to add up all of my liabilities. 52.5. Okay. The difference between these two accounts, or these two values rather. Oh. Bear with me here. The difference between these two is 48.5. So I'm going to plug in my 48.5. look what happens. Liabilities, or I'm sorry, debits equal credits. Okay? Perfect. So I'm done with UTEC. We got to do the same exact thing for float, right? So what's float contributing into this partnership? Well, they're contributing cash. They're also contributing receivables. They're also contributing inventory. Oh, sorry about that. And they're also contributing equipment. Okay. What about the liabilities? What liabilities are they contributing? Well, they're contributing, they have no notes payable, float, but they do have accounts payable of $40,000. Okay. So I need to credit, and remember, indenture credit, the accounts payable. I need to guesstimate what the allowance is. And I also need to calculate what the capital account value is for float. Okay, super easy to do, right? So float is putting all these assets in. What's the value of them? Well, let's go find out, right? Cash, they're contributing $8 grand. Well, that's easy. Okay. What about receivables? Well, they have receivables on the books for $30,000. If we look at the current valuation of that non-cash asset, they agree that it's 30 grand. So we need to journal that. Float is contributing $30,000 of receivables. Okay. What about inventory? Well, on the books, they have inventory at, let's see here, $20,000, right? But if we look at the current value, right, as of January 1, what is the value of this inventory, right? What's its fair market value? Well, they tell us down here that they agreed that the value of that inventory should be 25,000, not 20. So I'm going to plug it in. Okay. Now you might be questioning, how in the world did it go up 5 grand, right? What happened? Well, here's what happened. I don't know when, but it was a while ago, right? When Float had a proprietorship, they purchased inventory. They bought 20 grand worth of inventory. Some time passes. Float says, you know what? I don't want to be a proprietorship anymore. I want to form a partnership with UTEC. Great. Well, I got inventory that on my books is 20 grand. But what's it worth today? Meaning, if I had to replace this inventory, what's the fair market value of this inventory? Well, if they had to replace all that old inventory, they would have to pay $25,000 today. That's what they're contributing into, or that's the value of the inventory that goes into that that new partnership. So I'm going to go ahead and plug in the $25,000 for inventory, not 20,000. Okay. Same thing with the equipment, right? Look at the equipment here. On the books, they originally purchased it for 35,000, but then they have like 15 grand associated with accumulated depreciation of that asset. Okay, so that means the assets, valued at 10 grand, if my math's right. Or 15 grand, sorry. That's not correct, right? We don't care what they have it on their books for. We care what is the value of that equipment today, right? So Float said if they were going to purchase that same piece of equipment today, it would cost them 18 grand, right? That's the fair market value of that asset, $18,000. So I need to book that, 18 grand, right? And again, it's just the fair market value that we got, okay? Accounts payable. How much accounts payable are they contributing? Well, Accounts payable doesn't have a current non-cash value. So we're taking it for what it's worth, right? 40 grand. They tell us from their trial balance that they owe a bunch of suppliers $40,000. We're going to take it for what it's worth. Okay? Same thing for allowance for doubtful accounts, right? They originally they had a guesstimate of 3 grand. But they're forming a partnership. They reanalyzed the receivables, and they said, you know what? The allowance for doubtful account, we should probably up that. It should probably be 4 grand. That's what they agreed on. That's fine. We're going to go ahead and put it in. Okay? Now, we need to figure out what is the owner's capital, right? Originally, when Float was a loan, Float had capital of $35,000. If we plug it in, it won't work, right? We need to go back to the accounting equation. Assets equal liabilities plus owner's equity, or owner's equity equals assets minus liabilities. So let's figure out what are the total assets that we invested, meaning what Float invested. 81 grand. Okay, that's cool. How many liabilities do we have and how many credits do we have? Well, we got 44. Okay. I don't know why is that there. Bear with me here for a second. Equals this plus this. There we go, 44,000, right? So what should their owner's capital account be, meaning Float? How much capital does he have invested in this company? Well, we take the assets minus the liabilities. We get 37,000. I plug that in. And just want to add them just to make sure. Yep, they equal. We're good. Okay? The next thing we need to do is we need to journal the additional cash that each owner of this partnership agreed to contribute. Okay? So we know that UTEC, actually let's change that to capital. It's the capital account for UTEC. Had to contribute an additional $3,500. Okay? And then we go down to Float. Float has to invest an additional $16,000 in cash. Okay? So, same journal entry. Cash, capital. Right? Think back to accounting 1. Nothing new, right? What's a journal entry when an owner contributes cash into the partnership or company, whatever? Debit cash, credit capital. Because it's a partnership, we need to notate which partner's capital account is this? Well, it's Float's. Okay? And we contribute 16 grand. So we need to debit cash for 16,000, credit Float capital for 16,000. Okay? Now, the next thing we need to do is we need to prepare the classified balance sheet. So I'm hoping that this serves as a good review on how to put together a classified balance sheet. Okay? So, first thing that I want to do is I need to, on our spreadsheet, I need to create the balance sheet in proper form, right? So I'm going to pick an arbitrary amount, right? I'm going to go to J1. Actually, I'm going to go to I1. And I'm going to come over 5 columns. And I'm going to merge and center. I get my little crosshairs, and I'm going to drag down 1 row, 2 rows. So I have 3 rows here, right? So remember, whenever we're doing an classified balance sheet or any financial statement, we have to have the proper heading, right? Proper heading says company name. Now, they don't tell us what the name of this new partnership is called, right? So we can just make something up, right? We could say UTEC/float partners. Okay. Next thing we need to name the financial statement that we're doing. Well, we're doing a balance sheet. And we need to have the date, January 1, 2017. Okay? This is proper form, right? Everything should be centered in the middle of this new column that we created. Okay? Now, underneath the date, I want you to come over 5 rows and I want you to merge and center again. We're doing a classified balance sheet, so we need to classify, right? Assets always go first. So I'm going to type in assets and I'm going to list out all the categories of my assets and put all the accounts that go into each of those categories. I'll show you what I mean. So what I'm going to do is I want to click and drag 3, right? Well, let's put it this way. I'm going to click on I5 and I'm going to drag over 2 additional spots. Merge and center, left align. So the first thing I need to list out is my current assets. Excuse me. So underneath current assets, I'm going to merge and center those first 3 rows in this, or I'm sorry, first 3 columns in this row. I merge and center, left align, and I'm just going to click and drag an arbitrary amount. Okay. Again, just to make sure that we have enough space. Okay. Now, normally, after we do the journal entries, we post to the ledger, then we do the financial statements. We can skip the posting. The only problem is we need to be very careful when we're calculating the account balances from the journal. Let me show you what I mean. Okay. First current asset is cash. So I'm going to type in cash. Now, I need to make sure that this balance sheet is in proper form. So all the current assets need to be indented once. So I'm going to click indent. Notice how it brings cash over. Okay. And bear with me here for 1 second. You don't need to do this. There we go. So I have a thick outer box so we can just see where, hopefully it makes it a little easier to see where we're working. Okay. So I typed in cash. I'm going to tab over once. We have this middle column here, right? Column L. We're going to leave that where it is. Column M. We're going to calculate the total cash value of, or the total value of the cash account. So I need to go in and I need to go through my journal entries and pick all the journal entries that hit cash. Okay. So the first journal entry, UTEC debited cash for $10,000. I'm going to include that. January 1st, float contribute a bunch of assets and liabilities to the company, but in cash, they contributed $8,000. Then we have some additional investments, right? UTEC invested an additional $3,500 in cash, and float also invested an additional $16,000 in cash. Click those, hit enter, $37,500. That is the value of my cash account. Okay. Next thing we need to count for are accounts receivable. Now, I'm going to post the total in L. Okay, column L. Oh, go back, forgot to indent. Okay, so I need to add up all the journal entries that hit accounts receivable. Okay, so if we look at January 1st, the UTEC journal entry, they contributed $18,000 into this partnership. Float contributed $30,000 of receivables or accounts receivables into the new partnership. I get a total of $48,000 of accounts receivable that the new partnership has. Okay. The next thing I need to do is I need to list, or I need to less my allowance for doubtful accounts. So I need to go back to my journal and I need to say, okay, let me pull out all the journal entries that I hit the allowance for doubtful accounts. So we see that the first journal entry we did, UTEC, has allowance for doubtful accounts of $2,500 plus Float has allowance for doubtful accounts of $4,000. I plug those in, okay? Now, I'm going to total these, right? Or I'm going to make a calculation here. So what I want to do is I want to go ahead and select my bottom border. I come over to M8, which is right next to the allowance for doubtful accounts, and I'm going to report what my net accounts receivables are. Well, 48,000 minus 6,500 gives me 41,500. The next thing I need to do, indent, is list my inventory. Okay. What is the value of my inventory? Well, that's easy, right? Let's look and see what we did. Well, UTEC contributed inventory of $38,000 plus Float contributed inventory with a value of 25,000. So that means that my total inventory should be $60,000. Okay. So now what I need to do is list my, or total up my total current assets. So once we list all the current assets, like we did here, go under the last current asset that we have. In this case, it's inventory. And I want you to indent twice. 1, 2. And I want you to type in total current assets. All I need to do is sum up my current assets. Well, I have cash of 37.5. I have net accounts receivable 41.5. And then I have inventory of 63,000. That gives me 142,000, which does not look right. Okay. So the next thing we need to do is list the next category of assets that we have. Well, in this case, it's property, plant, and equipment. Okay. So I need to go ahead and list out all my PP&Es, right? Well, this one's kind of easy because each of these owners contributed equipment, right? There's no property that we need to list, no plant. It's just straight equipment. That's easy for us. So I'm going to type in equipment. Notice I indented once after I put my total here, or my section title, if you will, or the title of PP&E. So I'm going to go ahead and list all of my property, plant, and equipment. Okay, no problem. So how much equipment did this company contribute? Well, UTEC contributed 30,000 into this partnership, plus Float contributed $18,000. I get 53,000. The next thing I need to do is list out what are my total assets. And I need to auto sum. I need to add my total current assets plus my equipment. I get $195,000. Okay. Now, notice what we did here, right? We have a bunch of numbers and that doesn't tell us anything, right? So notice what happens here. Total current assets is $142,000. Okay. If I am in this cell and I click top border, notice what it does. it puts a line there. So it's very easy for us to tell that we added up these three numbers and we got 142,000 for total current assets. Okay. We're going to do the same thing with total assets, right? We're going to click our drop down and we're going to click top and double bottom border. And there we go. So we see here that our total assets have to equal 195,000. Okay. Now we can do the second part of the classified balance sheet, and we could do the liabilities in owner's equity section. Well, in order for me to do that, I need to put in that title, right? So I'm going to select all of these three columns that are underneath total assets. I'm going to merge and center once. That puts everything back to normal. Click it again, and notice now everything is centered and merged. So I'm going to type in liabilities and owner's equity. So this is going to be the liabilities and owner's equity section of my balance sheet. No problem. So what are the classifications of liabilities? Well, we have current liabilities and long-term liabilities. Okay. Remember what our current liabilities are. They're anything that will be due within the year or the operating cycle, whichever's longer. Okay. So the first thing we have is notes payable, right? And we see that the notes payable, or we need to go back and say, okay, who signed a note, right? Did both UTEC and Float sign a note? And are they contributing those notes into the new partnership? Well, they are. They are going to contribute all the assets and all the liabilities that they originally had and put it into one company, okay, or one partnership. Now, if we look through our journal entries, we can see that notes payable was contributed by UTEC. Float did not contribute any notes payable. So I'm just going to type in my $20,000. Okay. I messed something up. I apologize. I'm going to insert a column here, or insert a row. And I'm going to shift everything down. Okay, perfect. Above notes payable, these three columns here, I want to make it one column, so I'm going to merge and center, left align. I need to title this as current current liabilities, because this is the current liabilities section within the liabilities and owner's equity section. Okay, so I need to indent my note, which I already have, and I have my $20,000. Okay, next current asset I need to list are going to be my accounts payable. Okay, make sure you indent once. See how nice this looks? The title of current liabilities is strictly left aligned, or completely aligned to the left. And then I list all the current liabilities and slightly indent them. Okay? So let's go and figure out, within this new partnership, what is the total value of the accounts payable account? Well, that's easy. I know that UTEC brought over $30,000 in accounts payable. I know Float brought $40,000 of accounts payable in. 70 grand. Okay. So now that's all my current liabilities. I need to indent twice, 1, 2, and I need to say total current liabilities. Now I'm going to add this up. So what I want to do is I want to make sure I have a bottom border where my accounts payable is, to show that this cell right here is the calculation of the two above it, right? So I'm going to auto sum these. I get 90 grand. Now the next section is going to be our owner's equity. So make sure we're completely left aligned. And now I'm going to list out all of my capital accounts. Well, who do I have? I got UTEC capital and I got float capital. How did I know that? Well, I looked at my journal entries, right? Pretty easy. So we're going to indent once, excuse me, and I'm going to type in capital, comma, UTEC, and I'm going to come, excuse me, to my center line here, the L column, and I'm going to add up all the journal entries in which we either debited or we credited capital UTEC, or capital account for UTEC. So originally we credited UTEC's capital 48,500, and then UTEC contributed an additional 3,500. So we have $52,000 is the capital account for UTEC. Okay, we're going to do the same thing for float. So I'm going to type in capital, comma, float, and I'm going to calculate float's capital, right? What is the total value of float's capital account? Well, that's easy, right? The first journal entry that we did for float shows that $37,000 was booked as capital. Then they invested additional $16,000. So we have a total of $53,000 capital for float, okay? Underneath the capital account float, that $53,000, I want you to put a bottom border because I'm going to show here that we're going to calculate this, okay? So what are we calculating? Well, we're calculating total owner's equity. So I'm going to indent twice, 1, 2, and say total owner's equity. And I'm going to come over to my M column to put my total, and I'm going to auto sum these. Okay, 105. Now, I need to total this section, meaning what are the total liabilities and owner's equity? Well, that's easy. Come underneath your total owner's equity row here. Make sure you're completely left aligned and type in total liabilities and owner's equity. And again, I'm going to foot this column right, or this section right here rather, with a top and double bottom border. Oh, sorry about that. Okay, so now I'm going to add my total current liabilities to my total owner's equity, and I get $195,000. This is correct. I know that because assets equal liabilities plus owner's equity. I'm just going to dye these yellow. You do not have to do this, just to show that we are in fact balanced. Assets do equal liabilities plus owner's equity. Now, please be very aware, cognizant of how we set up the balance sheet, right? Notice that we put a title. Hey, here's all my assets. Then I'm going to list each category of assets. Current assets. That's all we have, current assets. The property, plant, equipment. And then we totaled out the total assets, right? Notice that each of the items that fall within a category, whether it's current assets or property, plant, equipment, are indented once, okay? Notice that whenever we total a section, meaning current assets, the current asset category, we need to total that. We indent twice, okay? Any classification titles like current assets, property, plant, equipment, those are all left aligned, okay? Same thing with our liabilities and owner's equity. That's the next section. Okay, well, within liabilities, what are our categories? Well, we either have current liabilities and or long-term liabilities. Okay, we don't have any long-term liabilities here. That's okay. But again, notice we have the category title of current liabilities left aligned, completely left aligned. Then we list each account which fits within that category, right? So what are our current liabilities? Well, notes payable, accounts payable, okay. We indent those once, or we have one indent for each of these. And then we have to, once we list all those accounts within that section, we have to total out that section. So we have total current liabilities. Notice it's double indented, okay? Same thing with owner's capital. Here's the owner capital section. Okay, great. How many owner's capital accounts do I have? 2, right? So we need to list each of them, making sure that they're indented once. Then we need to total this section of owner's equity. Notice the total line is indented twice. And then when we get to the overall section total, meaning total liabilities and equities, we're going to present what is the total of those. Notice that the line is left aligned, completely left aligned. Okay? So this is how you need to correctly put together your balance sheet. It should be in this exact format. Okay? In 12-1A, you do have to do that balance sheet. Okay? So please make sure it looks identical to this. If you got any questions, you know how to get a hold of me. Shoot me a text. Be glad to walk you through any Excel questions or formatting Excel questions you have, or journal entry questions, okay? We come back in our next video. We're going to look at problem 12-3B, which is identical to your homework problem 12-3A, okay? So thanks for tuning in, and we'll see you in our next video.